Welcome dear students, myself Professor Vikrant Palatsha. I welcome you all in my YouTube channel Professor Vikrant Palatsha's Education Hub. Dear student, in this video we are going to study the unit number 1 of the FY BCom Financial Accounting 1 subject, that is amalgamation of the partnership firm. In the previous video of this unit, we have studied about what is amalgamation. We understood the meaning of the amalgamation. We have also studied the various objectives of the amalgamation, and we have seen the several advantages of the amalgamation. Dear students, in this video, we are going to study the accounting treatment and preparation of ledger accounts while doing the amalgamation of the partnership firm. So amalgamation of the partnership firm includes, first of all, the closing the old books of amalgamating firm and thereafter opening the new books of amalgamated firm. In short, first of all, while doing the accounting treatment and accounting process under the amalgamation of the partnership firm, we have to first of all close the books of the old firm, and afterwards we have to open the books of the newly formed firm. Okay, so first of all, now we are going to study steps to close the books of amalgamating firm. Means how to close the books of the old firm, and for that which steps we have to perform, that now we are going to study. So under that, step number 1 is prepare a revaluation account to ascertain the profit or loss on revaluation of all assets and liabilities and transfer such a profit or loss to partners capital account in the old profit sharing ratio. So first of all, to close the books of the old firm or the amalgamating firm, we have to prepare the revaluation account. Revaluation account is also called as a profit and loss adjustment account. In this account, we have to find out the revaluation profit or the revaluation loss. So the assets, the liability which are transferred towards the new firm or towards the amalgamating firm, those all assets and liabilities accepted by the new firm at revalued price, and that revalued price we have to record to the revaluation account, and then we have to find out the revaluation profit or revaluation loss by preparing the revaluation account, and that is the step number 1. After that, the step number 2 we have to follow, in that on raising goodwill of the firm, goodwill account should be debited and partners capital account should be credited in their old profit sharing ratio. Suppose the goodwill is not given in the old firm books, and if it is raised at that time, the amount of the goodwill we have to transfer to the credit side of the partners capital account, and we have to distribute that amount of the goodwill amongst all partners according to their profit sharing ratio. And the second effect of the same we have to show to the debit side of the goodwill account. That is the step number 2. The next step number 3 that we have to follow, realize those assets which have not been taken over by the new firm and transfer such unsold assets to the partners capital account in the capital ratio. The assets which are not taken by the new firm, all those assets we have to transfer to the partners capital account, and we have to distribute all those assets amongst all the partners according to their capital sharing ratio, that is called as the capital ratio. That is the step number 3. Then we have to perform the step number 4, discharge those liabilities which have not been taken over by the new firm and transfer such undischarged liabilities to the capital accounts of all partners in their capital ratio. Like the assets, if suppose some liabilities which have not been taken over by the new firm, we have to transfer all such liabilities to the partner's capital account, and we have to distribute all those liabilities amongst the partner according to their capital ratio. That is the step number 4. After that, we have to perform step number 5. Transfer all accumulated reserves or profits or losses to the capital account of all the partners in their old profit sharing ratio. Suppose any kind of reserves, any kind of surplus, those have been provided to the balance sheet liability side of the old firm. All such reserves are all such profit we have to transfer to the partners capital account, and we have to distribute all those profits and reserves amongst all partners according to their old profit sharing ratio. Vice versa, if any kind of loss is given under the asset side of the old partnership firm, all such losses also we have to transfer to the partners capital account and distribute all those losses among all the partners according to their profit sharing ratio. That is the step number 5. Afterwards, we have to perform the step number 6. In that, close the accounts of liabilities taken over and accounts of assets taken over. Whatever assets, whatever liabilities taken over by the new firm, related accounts we have to close. And then the last step we have to follow there, we have to close the partners capital account and the new firm account, and in this way we have to complete the procedure to close the books of the old firm, that is amalgamating firm. So therefore, to close the books of the amalgamating firm or to close the books of the old firm, these are 7 steps we have to perform. So this is the procedure, this is the accounting process that we have to perform to close the books of the old, that is amalgamating firm. Dear students, in the next video now we are going to study which journal entries we have to record in the books of the amalgamating firm, means in the books of the old firm. So dear student, in this video we have discussed the steps those are required to close the books of the amalgamating firms, means the books of the old firm. I hope all the information that I have given in this video you understood very well. I request all of you kindly subscribe my YouTube channel for such more videos. Thank you all of you.